You are not gonna believe this. The Fed just cut interest rates, and according to market forecast, there could be 2 more cuts this year. So, is the housing market finally coming back to life, or is this just another fake recovery? And get this, Zillow just flipped its forecast again. 6 months ago, they said prices would drop. Now they're saying they will rise. So what's really happening? Can home prices still fall after a rate cut? Or is the housing crash story officially over? Last month, the Federal Reserve made its first rate cut of 2025, bringing mortgage rates to the lowest level in a year. Some people are refinancing and buyers are getting active again. It feels like the market's waking up, but is that real momentum or just hype? Before we dive in, I'm Maggie. This year, our team has closed over 130 deals, totaling more than $170 million. Whether you are buying, selling, or investing, we are here to help you make smarter real estate decisions. Today, we'll break down to 3 things. First, how the housing market is reacting after the rate cut. Second, what's happening right now in Seattle. And finally, what buyers and sellers should do next. Don't forget to like, save, and subscribe for more updates on the US and Seattle housing market. So, let's start with the big one, interest rates. On September 17th, the Fed cut rates by 25 basis points, bringing the federal funds rate down to 4.0 to 4.25%. That's the first cut of 2025, and markets expect 2 more this year. According to the CME FedWatch tool, there's a 95% chance of another cut by October and about 80% chance of 1 more in December. So a 3-cut year is pretty much locked in. Now, what does that mean for mortgage rates? According to Freddie Mac, as of October 2nd, the 30-year fixed rate is 6.34%, and the 15-year fixed is 5.55%. That's barely higher than last week, but we're already seeing borrowers locking below 6% on new loans. In fact, some of our clients just closed at 5.8 or 5.9 on the 30-year fix and around 5.5 on the 15-year. So yes, rates are coming down, but slowly. It's not a crash, it's a slide. Now, what's actually happening in the US market? Prices aren't crashing, but they're not soaring either. According to Redfin, the median sale price is around $390,000, up 2.5% year over year, the biggest gain in 6 months. The median asking price is about $404,000, up 2%, but monthly payments are still high, at a 6.3% rate. The typical payment is around $2,590 a month, up roughly $40 from August. Pending sales are down 0.9% year over year, the biggest drop in 5 months. And inventory is up. There are roughly 500,000 more sellers than buyers right now. That means buyers have more leverage, especially on homes listed for 3 weeks or more, or that have had multiple price drops. So nationwide, it's a balanced market. Prices are stable, sales are slow, and negotiation is back. Now, let's talk about the big headline. Zillow's forecast flipped. At the end of September, Zillow changed its 12-month outlook again. Back in April, they predicted prices would fall 1.7%. Now, they're expecting a 1.2% increase. Sounds like a rebound, right? But really, it's more of a correction from over-pessimism. Earlier this year, Zillow went from 2.6% to minus 1.7%, then positive 0.4%, and now positive 1.2%. That is a roller coaster, right? So why the change? First, supply growth is slowing. New listings were only up 2.5% in August, much less than spring. Many sellers are waiting on the sidelines, keeping inventory lower than expected. Second, buyer confidence is coming back. People see rates easing and expect financing to get cheaper. Third, first-time buyers are active again. Zillow says starter home sales rose 4% in August, but don't assume prices will soar everywhere. Zillow calls it a structural recovery. Some areas will rise, others will still drop. The biggest gainers are in the Northeast, Atlantic City, Torrington, Providence, each up around 4%. And the biggest declines are in the South and West. New Orleans down 4.8%, Austin down 2.4%, San Francisco down 2.3%. So the U.S. housing market is now divided. Low inventory areas will keep rising, and high inventory areas may keep sliding. Now, let's bring it home to Seattle. According to Zillow, prices here are expected to stay flat, 0% change over the next year. And honestly, that matches what we're seeing on the ground. Two forces are pulling opposite directions. Lower rates are helping buyers, but inventory build-up and a cooler economy are keeping a lid on prices. The result is a sideways market. The median price here is around $860,000, up 1.2% year over year, but down 1.1% month to month. The average price per square foot is about $531, roughly flat from last year. Inventory is steady at 3.5 months of supply, and days on market average 20 days, about 50% longer than a year ago. That means buyers now have more negotiating power, but it depends on the segment. Single-family homes are still doing pretty well, up 2% year over year, with 2.9 months of inventory and 16-day median days on the market. That's still a seller's market. Condos, though, are down 6%, with 4.4 months of inventory and doubles the days on market. That's a buyer's market already. So overall, Seattle is balanced, but the story changes by neighborhood and property type. All right, let's get to the practical part. What should you actually do now? For buyers, this market is friendly. Inventory is up, sellers are more flexible, and rates are gradually coming down. If you're a first-time buyer or need a home now, this is the time to shop smart. Look for homes that have been listed 30 days or more, or that have price reductions. That's where you can negotiate. Also, check new constructions. Across the U.S., new homes are now priced 4 to 5% below resales. Builders are offering rate buydowns, closing credits, and even zero loan fees to move inventory. If the location and budget fit, that's a great opportunity. And remember, don't let short-term price swings decide your home buy. If you are buying to live, focus on the layout, neighborhood, and affordability. You are locking in a 30-year home, not a 30-day rate. For sellers, you can still win, but you can't be greedy. Competition is up, and buyers are now negotiating harder, so pricing strategy is key. Don't list at the peak from 3 months ago or from a year ago. Price slightly below your competition, and you'll get the most traffic and offers. Use small incentives like a rate buydown, or a closing credit, or a home warranty. They work better sometimes than a big price cut. And if your home's been on the market over 20 days with no serious offers, the price is probably too high. Timing matters too. The best selling season is spring through early summer, then again in September and October. If you miss the fall window, start prepping now. Do touch-ups, paint, flooring, landscaping, so you're ready for spring 2026. By then, if rates keep falling, buyer demand will come back stronger, and the key is this. You can't control the market, but you can control your strategy. Adjust to where the market is now, and you always find opportunity. Before you go, don't forget to like, save, and subscribe for more real-time updates on the US and Seattle housing markets. Thank you so much for watching. I'm Maggie, and I'll see you in the next video.